Introduction. The iron law of nature is that you receive what you deserve. Suppose you could buy a business just by talking to its operator for 30 minutes. No financial reports, no technical charts, no market data. What would you ask, and more importantly, what would you believe in order to make the decision? In an era where people mistakenly think investing is the art of clicking faster and smarter algorithms than the next person, this book, Chairman Lead Investor, does not offer get-rich-quick secrets. It does something far more dangerous. It demands that you pause and think. And that is exactly why it is inconvenient, addictive, and not meant for those seeking a feeling of safety. Munger doesn't give advice. He throws out paradoxes. He doesn't copy down rules. He questions foundational beliefs. And in a world of investing filled with noise and prejudice, that uncomfortable level of clarity is what makes his thinking as urgent as a flashlight in a room full of distorted mirrors. This book does not require you to agree or approve. But if you are brave enough to be challenged and humble enough to look inward, very likely you will never look at investing, or the way you make decisions, the same way again. We encourage listeners to buy and read the book to fully experience its content. For now, let's begin together. Chapter 1: The Fundamentals of Graham's Value Investing System. I never believed investing is an art reserved for geniuses. I believe it is a survival skill, like learning how to survive in a jungle. Not through innate brilliance, but through clearly understanding where you stand, what you are facing, and when to retreat. That is why I followed the path of Benjamin Graham. He didn't just teach me how to read a balance sheet, he taught me something far more important. When the market goes mad, the person who knows how to stand still is the winner. I began my journey in the investing world with simple questions. Why do people invest? How do you avoid losing money? What makes a good decision? And then, as if the universe deliberately arranged it, I encountered Graham's philosophy. His philosophy was unlike anything I had seen on Wall Street, where people seemed to be engaging in educated gambling. Graham forced me to stop. He said, investing is when you carefully analyze, can ensure the safety of capital, and have a reasonable expectation of profit. If any of these three conditions is missing, it is not investing, it is speculation. It sounds simple, but to actually live by that philosophy amid market chaos requires what I call steel rationality, something very few people possess and no school teaches you. Graham was like a strict but sincere father. He didn't sugarcoat the dream of getting rich. He forced you to look straight at reality. He taught me that the intrinsic value of a company is not what flashes on the ticker screen. It is an estimable number based on the future cash flows the business can generate, discounted to the present at a reasonable rate. If the market price is significantly below that intrinsic value, then you have an opportunity. If not, walk away. Once I asked, what if I don't understand the company? Graham smiled, put it in the too hard pile. You don't have to invest in everything. You only need to wait for clear opportunities, like waiting for a fat pitch right in your strike zone. That is what I learned from Warren Buffett, the man I was fortunate to walk alongside. He has a bucket with 3 labels: yes, no, and too tough. Most opportunities fall into no or too tough. Only a few fall into yes, and those are usually the truly great ones. Our philosophy is, you don't need to invest frequently, you only need to invest correctly when the moment arrives. I have watched many new investors enter the market like stepping into a casino. They get swept up by the rhythm, the cheers, the charts. They forget the most important thing. Behind every stock ticker is a real business, with real people, real machines, and real money flowing in or out. One of Graham's life or death principles is the margin of safety. Imagine building a bridge. If the maximum load is 10 tons, you build it to withstand 30 tons, not because you're afraid, but because you are wise. In investing it's the same, buy when the price is sufficiently below intrinsic value so that even if you're a little wrong, you still survive. I have seen too many people die because they had no margin of safety. They bought because of news, rumors, fancy technical analysis that smelled rational but was actually hollow. They walked as if they could never fall, and when they did fall, they could not get back up. I don't deny the importance of analytical skills, but if I had to choose between someone who understands finance extremely well but is easily swayed by emotions, and someone with average analysis but iron discipline, I would bet on the second person. Because the market is a place where emotions are amplified, greed, fear, euphoria, despair, all playing out every hour, every minute. The survivors are not those who spot the best opportunities, but those who can say no to 99% of things that aren't necessary. That's why I always start with these questions. Is this company easy to understand? Does it have a clear business model? Does it have a durable competitive advantage? Does it have trustworthy leadership? I don't need it to grow like a rocket. I just need it to be a slow, steady, hard-to-displace cash machine. Some people ask me, aren't you being too conservative? I just smile. I didn't come to the market to be a pioneer. I came to survive and accumulate. Real wealth doesn't come from reckless home runs, it comes from not making catastrophic mistakes over 30 years. To invest effectively, you must be willing to wait, and waiting is not passive. It is a very active, very difficult form of action. I have sat still for years without making any new investments. Not because I had no money, but because I found no opportunity worthy of it. Most people think investing is a constant stream of activity. They see cash sitting idle and think it's wasted. But I think like a sniper, if the target isn't clear, I don't pull the trigger. I'd rather be called slow than face the consequences of acting hastily. Another important part of my philosophy is contrarian thinking. If most people are doing something, I immediately become suspicious, not because I like to oppose, but because I know herd psychology often leads to disaster. People tend to buy when prices are rising and sell when they are falling. I do the opposite. I buy when there's blood in the streets and sell when everyone is partying on the exchange floor. I've been asked, how do you know when it's the bottom? I reply, I don't need to know. I just need to know when the price is so far below intrinsic value that my margin of error won't kill me. In my early years, I was obsessed with calculating every ratio, every cash flow, every yield. But the longer I went, the more I simplified. I learned to look at the bigger picture. Is this an understandable business? Is it honest? Does it have real earning power? Is the market mispricing it? If the answer is yes, I don't need more data. I like businesses like Coca-Cola, Costco, where everything is clear as daylight. You don't need to be a finance expert to see how well they operate. Businesses like these have a huge advantage, they depend less on genius management because their systems are strong, stable, and hard to copy. In the investing world, people chase alpha, excess return over the market. I chase negative beta, the ability not to die when the market goes insane. Surviving is already winning. Because if you preserve capital through many cycles, the compound interest will take care of itself. Compound interest needs two things, time and not losing capital. Good investment decisions never come from a disordered mental state. When you're angry, euphoric, panicked, or competitive, that's when you make the worst mistakes. So I often let a decision sleep overnight. If it still looks reasonable the next morning, then I act. I've missed many opportunities because of that caution. But I've never regretted missing. Missing is part of the game. You don't need to hit every pitch. You just need to avoid the ruinous swings. People lose because of catastrophic errors, not because of a lack of opportunities. That's why I don't chase trends. During the dot-com boom, I stayed out. During the real estate frenzy, I stayed out. I was called outdated, behind the times. I didn't care. I don't invest to be applauded. I invest to achieve freedom, freedom from the fear of losing money, freedom from being a slave to the market. Is there a secret to success? I don't believe in secrets. I believe in discipline. I believe in knowing your limits. I believe in repeating the right things for a long enough time. I also never forget that I can be wrong. That's part of the survival strategy. I always assume I'm wrong and only act when the degree of possible error still allows me to survive. This isn't lack of confidence. It's a self-protection strategy in an uncertain world. Graham once said, "In the short run, the market is a voting machine, in the long run, it is a weighing machine." I live by that. I don't seek consensus. I seek the true weight of a business. And I'm willing to wait until the market sees it too. There is another path, a path without noise, without gambling, without recklessness. It only requires enough patience, rationality, and humility to accept that you don't need to do everything, just do a few things, really well. And that is how I have lived, invested, and walked through for decades without being swallowed by the market. Chapter 2: The Principles in Graham's Value Investing System. I once thought investing only needed a few mathematical formulas and financial reports. But then I realized, like any long game, investing is not just a skill, it is a philosophy of life, something that demands principles. And without principles, you will always be led by the market like a hunting dog chasing a whistle, never knowing where you're really going. Graham gave principles like a compass to keep you oriented in the chaotic world of investing. For me, each principle is like an arrow on the compass, keeping me from getting lost in the madness of Wall Street. First principle: distinguish between investing and speculation. It sounds simple, but ask 10 people buying stocks right now, probably 7 don't really know whether they're investing or just betting the price will go up. Graham said, if you're not sure whether you're investing, you're probably speculating. I like that gentle sarcasm. It wakes people up. I've seen speculators make fortunes in one season. They brag about strategies, share tips, open get-rich classes. But as soon as the market turns, they vanish like soap bubbles. Real investing isn't glamorous like that. It's slow, boring, sometimes makes you doubt yourself. But it lasts, like a northern pine standing through blizzards. Second principle: protect capital first. Profit comes second. This principle has saved me from dozens of bad decisions. I don't look for the highest possible return. I look for the maximum reduction of risk. You might call it timid thinking. I call it understanding what kills investors fastest. You can make 100% in a year, but if you lose 50% the next year, you're not getting anywhere. I learned to put myself in the worst-case scenario before signing anything. I always ask, if everything goes wrong, do I survive? If the answer is no, I step back, even if the opportunity looks tempting. Third principle: always demand a margin of safety. I've talked about it already, but I'll say it again because everything starts here. The market doesn't forgive mistakes, and since you're human, you will make them. The margin of safety is the only cushion between you and collapse. If the stock price is 30 to 40% below the intrinsic value you've carefully calculated, and your calculation is sound, that might be an opportunity. If it's only 5% below, I call that gambling. Fourth principle: the market is a manic-depressive neighbor, Mr. Market. This is one of my favorite images from Graham. He said, imagine you own a business and every day a neighbor named Mr. Market knocks on your door offering to buy or sell your share at wildly different prices, sometimes absurdly high, sometimes absurdly low, with no logic. The magic is, you don't have to deal with him every day. You can ignore him until he offers a price that benefits you. The market is like that. You don't need to predict it. You just need to master yourself in front of it. Fifth principle: value investing is investing in businesses, not in stocks. This sounds easy, but very few people truly get it. They see a ticker symbol, a price, a chart, but they don't see the company behind it. I once asked a new investor, "What are you investing in?" He answered, "A stock that just broke out with a very strong pattern." I shook my head. I wasn't asking about patterns. I was asking about the business. Graham taught me to look through the charts, through the reports, to see a real company, with real products, real cash flows, real people. Only when you understand the company as well as you understand yourself should you put money into it. The final principle in Graham's system: discipline. Nothing replaces discipline, not intelligence, not networks, not speed of reaction to news. All of it is meaningless if you cannot do the right thing consistently, year after year. I'm not saying I'm perfect. I've made mistakes, been tempted, been persuaded by promises of huge returns. But what pulled me back every time was returning to these principles. They are like milestones planted along the road in thick fog. You may not always see the destination, but you always know you're not falling off a cliff. These principles remained theory until the market really punched me in the face. That happened in the early 80s when an investment I pursued, full of logic, full of data, suddenly plunged just because of a government tax policy change. The real value was still there. The business was still doing well. But the stock price fell like a stone. I sat there watching my investment drop day after day and asked myself, am I wrong, or is this Mr. Market having one of his manic episodes? I didn't sell, because I understood the principles. Many years later that investment delivered larger returns than anything I had held before. That lesson didn't come from a classroom. It came from the scar the market left. That was when I truly understood, principles are not just theory. They are the blueprint for building a mindset, an inner strength. Without it, you are easily swept away by rumors, news, speculative waves. And the worst part is, you don't even realize you're being swept. Graham never taught me how to predict the market. He taught me how to respond to it with consistency. When everyone around you panics, can you keep your reason? When others are greedy, can you stand still? When others stand still, do you dare step forward? That is where principles show their power, not to win every game, but to never be carried away by other people's games. I call that disciplined independent thinking. Independent thinking lets you see the world with your own eyes. Discipline keeps you from betraying that vision when everyone else is looking the other way. There's one image I love when talking about principle-based investing, the farmer. You cannot make rice grow faster by yelling at it. You cannot fertilize it every day hoping to speed up the cycle. You plant in the dry season, care for it in the rainy season, harvest when the weather is right. Any impatience leads to crop failure. Investing is the same. Sometimes you must wait, sometimes stand still, sometimes cut losses, sometimes admit you were wrong. But you must never abandon principles, because principles are the only thing keeping you from becoming a speculator disguised as an investor. Do principles ever become outdated? I say, only when human greed becomes outdated, and I have never seen that happen. Greed is still there, like a shadow behind every rally. Fear is still there, like an echo beneath every crash. And as long as greed and fear exist, principles remain your only shield. It sounds like a monk on Wall Street, and honestly, it's not far wrong. Investing by principles is a journey that requires mindfulness, like meditation. Not because it demands you detach from life, but because you must learn not to let life control you. You must learn to say no to easy opportunities, no to rumors, no to get-rich-quick promises. Those very no's are what lead you to the greatest opportunities. Because when you have principles, you become rare, and in the investing world, what is rare has value. When I look back on 30 years of investing, it's not the biggest trades that make me proud, it's the times I did nothing at all. The times I kept cash in my pocket while the market was throwing a party. The times I refused a too-good-to-be-true opportunity because it was outside my circle of competence. Those are the moments when I clearly see, principles give you freedom. Without principles, you are a prisoner of yourself. Investing is not a game of who's faster, who knows more, who's bolder. It is a game of who understands themselves better, who waits better, who holds principles longer. You can be wrong many times. But if you are always wrong within the framework of principles, you still have a path to live. If you are right a few times by luck but have no principles, sooner or later the market will take back everything it gave you. That is everything I learned from Graham, not just to invest better, but to live more slowly, more clearly, and more sustainably in a world that always wants to push you faster than yourself. Chapter 3, Latticework of Mental Models, Universal Intelligence. I once thought knowledge came from books. Then I realized the world doesn't operate the way textbooks teach. It runs on intersecting systems, nested principles, hidden laws beneath the surface. If you look only through one lens, you will always miss the most important things. That was when I began building for myself a latticework of mental models, what I call universal intelligence. Don't let the fancy name intimidate you. The essence is very simple. I borrow fundamental principles from many different fields: psychology, physics, biology, mathematics, economics, law, and string them together like pearls to shine light on investment decisions. Because I believe truth is not only in accounting books. It lies in how people behave, how the world works, how beliefs form and collapse. Graham gave me the foundation of investing. But to grow beyond the limits, I had to step into a wider world. I studied physics to understand feedback loops, psychology to recognize cognitive biases, biology to see natural selection in businesses, history not to memorize dates but to see that greed and fear are two machines that never stop running in human society. When I said that on Wall Street, people laughed. They thought I was an eccentric old man musing about extinct dinosaurs while the market was going up. But then they started coming to ask me when the market crashed, because at that point, valuation formulas could no longer save them. They needed a broader cognitive system to understand what was really happening. Let's take an example. You see a company growing well, revenue beating expectations, market share expanding, everything looks beautiful. But if you don't understand the principle of regression to the mean, a simple concept in statistics, you easily believe the momentum will last forever. You invest as if tomorrow will be as bright as today. Then when the company slows down, you're surprised, panicked, and sell at a loss. But if you carry the regression to the mean model in your head, you know nothing grows forever at a constant rate. You prepare your mindset earlier than the market does. Universal intelligence allows me to look at a company the way a doctor looks at a patient, not just the test results, but the whole picture: lifestyle, genetics, reaction to the environment. It helps me detect abnormal signs before they become problems. For instance, a company with excessively hot growth is like a person drinking too much caffeine. Sooner or later complications appear. I believe an investor cannot just be a finance expert, they must be a thinker. If you're not curious enough to step outside your field, you will always be trapped in mental traps, thinking every problem can be solved with an Excel formula. In reality, the biggest mistakes in investing come from things Excel cannot measure: human dynamics, cultural shifts, network effects in society. I studied psychology not to manipulate others, but to protect myself from illusions in my own brain. I discovered that we are not as rational as we think. We are biased by confirmation bias. We are more obsessed with losses than with gains. We cling to the familiar. We project the future based on present emotions. If you cannot recognize these, you become their victim in every investment decision. I studied law to understand power structures. Sometimes the reason a company performs well is not the product, but the ownership structure and legal position. Understanding law helps me see who really controls the game and who is just a pawn, something financial reports never tell you. I studied biology to understand natural selection. I see the market as an ecosystem: weak companies get eliminated, adaptive ones survive. Sometimes a small mutation, a new technology, a change in consumer behavior, can cause mass extinction, just like dinosaurs didn't disappear because they were weak, but because they couldn't adapt fast enough to climate change. And I studied history so I wouldn't be surprised by repetition. People think every crisis is brand new, but if you read enough, you see old mistakes just wearing new clothes: the Dutch tulip bubble, the dot-com frenzy, Lehman Brothers collapse. All are manifestations of one thing: humans always think this time is different. I once sat in an investment meeting where people were raving about a hot tech stock. Everyone agreed it was the future of the industry, its business model was irreplaceable, that anyone not getting in now would miss the train. I sat quietly observing, not because I didn't understand, but because I had heard those exact words too many times, from Enron to Pets.com to dozens of other names once celebrated and then erased from the financial map. I didn't say anything. Sometimes intelligence is not in what you say, but in not getting swept up in the frenzy. Universal intelligence doesn't help you predict every market move accurately. It helps you not get destroyed by things others don't see. It's like having an extra radar: when the market is calm, you can still hear distant thunder, not to panic, but to prepare. I believe the real competitive advantage in modern investing is not information, not trading speed, it is integration ability. The person who can integrate mental models from many fields is the one who can see what others miss. And when you see what others don't see, you can do what others cannot do. Someone once said to me, "But I don't have time to learn so many things like you." I replied, "You don't need to learn deeply, just enough to have the right mental models. You don't need to become a physicist to understand chain reactions, nor a psychologist to spot cognitive biases. Just enough to ask a good question, enough to doubt what the surface is presenting." That's what I do every day. I read widely, not to become a scholar, but to become a survivor. I read about war to understand strategy, biology to understand competition, mythology to understand human behavior, probability mathematics to understand risk. For me, each field is a flashlight, and I need all of them to illuminate the investment picture I'm looking at. The world is not separated. A good investment decision doesn't come from one excellent spreadsheet, but from a chain of observations across disciplines, across time, across perspectives. Investing is not exact mathematics. It is a game of ifs and maybes. Universal intelligence helps you live in that fog. You might think I'm idealizing everything, that investing is about money, not philosophy. But I believe the opposite. Precisely because investing is about money, the thing that feeds you, decides your freedom, it requires more philosophy than any other field. If you enter the market just to get rich, you will quickly be pulled into a blind race. Only when you enter with a solid value system and thinking framework can you walk through storms without being knocked down. If you ask me where to start, I would say, begin with the things others don't bother to learn: behavioral psychology, history of financial bubbles, evolutionary biology, competition law, skeptical philosophy. You don't need to become an expert in everything, but become someone who can see the connections. And always ask, what mental model is operating here that I haven't yet seen? Graham gave me principles. Universal intelligence gave me eyes to see beyond the books. I am not a prophet. I am just someone who always tries to see the picture wide enough so that when opportunity arrives or danger appears, I am not caught by surprise. That is how I have invested, and also how I have lived, not with certainty, but with a system flexible enough to face uncertainty. And in this world, where everything keeps changing, that may be the rarest advantage you can keep for yourself. Chapter 4: The Psychology of Human Judgment Errors. I once thought mistakes came from lack of information. Then I met plenty of people drowning in information who still made terrible decisions. I once believed logic was the compass that guided us. Until I saw entire markets dragged along by stories that weren't true. That was when I began to understand, we don't fail because we're stupid, we fail because of the built-in dead ends in human psychology. Those dead ends don't appear as warning signs. They appear as attractive, familiar shortcuts, until you realize you've walked into the wrong place. That's why I spent a quarter of my life studying behavioral psychology, not to manipulate the market, but to protect myself from myself. I realized that in investing, the biggest enemy isn't out there, it's between your two ears. Recognizing the systematic biases and distortions in human judgment became a lifelong discipline. Take confirmation bias, for example. Once you believe something, you only seek information that supports it. You ignore contradictory evidence, or even dismiss it because it makes you uncomfortable. I've seen this happen to even seasoned investors. They fall in love with a stock and become blind to every warning sign. Then there's loss aversion, or regret aversion. You fear making a mistake so much that you either avoid acting altogether, or worse, you hold on to a losing investment just to avoid admitting you were wrong. I've watched people let half their wealth evaporate simply because they kept saying, "Just wait a little longer, maybe it'll come back." And herd mentality? That's when people do something just because everyone else is doing it. The crowd poured into Bitcoin in 2017, into tech in 1999, into real estate in 2006, all convinced this time is different. I learned, when you hear the phrase "this time is different," stand up and walk away. Most of us are far more pained by losing $1 than we are pleased by gaining $1. This leads to irrational behavior, cutting winners too early out of fear, holding losers too long to avoid the pain of realizing the loss. I made that mistake myself, and paid for it with missed opportunities. Anchoring bias is another dangerous trap. You see stock ABC once hit $100 and now it's at $60. You think it's cheap because your mind is anchored to the old high, even though the business's real value has changed completely. The anchor is worthless, but you're still chained to it. Then there's framing effect. The way information is presented changes how we evaluate the exact same investment. Say a 90% success rate and people get excited. Say 10% failure rate and they hesitate, even though it's mathematically identical. Media exploits this ruthlessly, and I've had to train myself not to be led by it. Overconfidence bias is one of the greatest hazards on Wall Street. People think they know more than they do. They mistake a few lucky wins for skill rather than chance. I call it the illusion of control, and it has turned many fireworks careers into ash with one big mistake. I've watched fund managers rise like rockets and fall just as fast because they believed they were the exception, immune to cycles. I never think that way. I always assume I can be wrong, and I build my entire investment system around one question. If I'm wrong, do I still survive? The combination of these psychological biases doesn't just distort individual judgment, it creates collective bubbles. A bubble is when one person's mistake is copied millions of times. Prices stop reflecting value and start reflecting emotion. At that point you're no longer investing, you're playing a collective psychology game where the last person holding the hot coal gets burned. That's why I always start by examining myself. I write down the biases I'm most prone to. I build decision processes that minimize emotional influence as much as possible. For major decisions, I force them through a series of contrarian questions. If someone I dislike proposed this deal, would I still like it? If the price drops 20% right after I buy, will I still have the rationality to hold? The smarter people are, the easier they fall into overconfidence traps. Those with high degrees, perfect scores, sharp minds, they're often the ones who lose the most heavily. Because not only do they misjudge the situation, they refuse to believe they can be wrong. So they double down on the first mistake, average down on the second, and go bust on the third. Investing is not an intellectual sport. It's a soft martial art. It doesn't demand you strike well, it demands you know how to avoid being hit. The most dangerous punches don't come from the market, they come from your own ego-driven blindness. I learned to doubt my own emotions. Whenever I feel too excited, I stop. Whenever I feel too afraid, I write in my journal. I never make decisions in an unbalanced mental state, because I know mistakes don't come from missing data, they come from the wrong emotional timing. Think about our addiction to short-term rewards, a legacy from our hunter-gatherer ancestors. Our brains release dopamine every time we make a profit, and we get hooked on that feeling, just like a gambler pulling a slot machine lever. We don't invest to get rich. We invest to feel right. And that makes us rush into decisions just to get confirmation. Once a young investor told me he had doubled his money in 3 months. I asked, "How have you prepared yourself mentally to lose half of that in a single week?" He laughed, "That can't happen that fast." I didn't reply. A few months later he came back, no assets left, only the question, "Why did this happen to me?" I told him, "Because you're human. And humans make mistakes." I don't tell that story to lecture anyone. I tell it to remind myself every day, if I don't constantly re-examine my thinking, I too could become a victim. I too could be swept away by a wave of euphoria, blinded by a string of winning trades. I don't believe in any system that doesn't leave room for humility, because pride is where the biggest failures begin. That's why I always leave part of my system for the unpredictable. I don't try to predict what the market will do. I prepare what I will do when the market does what I don't like. I maintain discipline not because I'm rigid, but because I know that in a high-emotion state, I'm no longer myself. I use checklists for every investment decision, the way a pilot checks the plane before takeoff. Not because I doubt my intuition, but because I doubt the version of me that's excited or under time pressure. The checklist preserves the clearest version of me, the one I trust most. I also learn to step back and view the market as a game I can choose not to play. I don't have to buy every day. I don't have to react to everything. Sometimes the wisest decision is to do nothing. People fear missing out. I fear jumping into things I don't understand. Mistakes are not the enemy. Hiding from mistakes is. If you dare look straight at why you were wrong, you can fix it. If you blame the market, circumstances, or others, you will repeat the same mistake in a slightly different costume. The market is a machine that transfers money from the impatient to the patient. I believe it's also a machine that transfers money from those who don't understand themselves to those who do. If you don't master your psychology, you will forever be a pawn on the chessboard of emotion. No matter how much data you have. I don't claim to be immune to biases. I only build a system to detect them as early as possible. And I live with the assumption that if I don't check my thinking today, tomorrow I might make an uncorrectable mistake. Because in investing, as in life, those who don't learn from their psychological errors will keep repeating them forever. Chapter 5: The Human Qualities Essential for Investment Success. The day I stepped into the stock market, I carried three things: a head full of curiosity, a cautious heart, and a copy of Graham's book tucked in my pocket. I thought, like many others, that if I just understood the numbers, memorized the ratios, and followed logic, I would succeed. But then I watched people smarter than me, more educated than me, collapse during turbulent market seasons. They had everything except the right character. Investing is not merely an analytical discipline, it is a lifelong psychological examination. The winners are not the best calculators, but those who survive the longest with a sound value system. I call this essential character stop, the right stuff. First quality, independent thinking, to the point of seeming eccentric. Someone who can step out of the crowd, not to be contrarian for the sake of it, but to see with their own eyes. They don't need market confirmation. They don't need others' approval. They are confident enough to say no when everyone says yes, and they don't feel strange holding only 3 stocks for an entire year while others churn portfolios like changing shirts. I once met such a person. He never watched financial news, never read technical analysis. He just read annual reports and shareholder letters year after year, holding his positions as if nothing deserved disturbance. And the result? He became 10 times richer than those blindly racing, because he didn't earn from speed, he earned from consistency. Second quality, iron discipline. Cold as the operator of a nuclear power plant, you cannot let emotion intrude on decisions. You cannot think you're invincible after 3 winning sessions. You cannot panic sell after 1 bad week. Discipline is not something you're born with. It is forged every day, every decision, every painful moment when you refuse a seemingly delicious opportunity because it violates principle. Third quality, lifelong learning, without information poisoning. You must continuously expand understanding, but you must know how to filter out garbage. I see many people read a lot, but their knowledge is like a tangled mess of wires, short-circuiting everywhere. The person with the right stuff knows how to filter. They don't need to know everything. They just need to know the few things that truly apply and discard the rest. Fourth quality, humility, to the point of regularly assuming you are wrong. People often say confidence is the key to success. I say humility is the door to survival. You can never believe you fully understood the market. You can never believe you're immune to bias. You must constantly ask, what if I'm wrong? And build your portfolio in such a way that even when wrong, you survive. I once knew someone who put everything into one stock because he understood it like the back of his hand. That year the company faced a major legal issue. His account dropped 70% and he vanished from the market. The lesson tells itself. Fifth quality, patience, to the point of being called lazy. The market is a place where the impatient pay the patient. I once went 18 months without buying anything. People asked, don't you see any opportunities? I answered, I see many, but none are safe. Then when the crisis came, I bought more stocks in 3 months than in the previous 3 years combined, at crisis-level bargain prices. The right stuff is not found in degrees, not in speed of reading reports. It lies in the core of a person's character. You can teach someone how to value a business. But you cannot teach them the ability to wait. You can show them discounted cash flow models. But you cannot teach them the courage to stand still when the market screams in panic. I once tried working with a very smart young man. He was excellent at math, quick, reactive to news, but he could not sit still. Every day he had to do something: buy, sell, analyze, hunt. I told him, investing is not a speed game. It's an endurance test of delay. He didn't listen. 6 months later his portfolio looked like a storm with no end, and he was trapped in a vicious circle. There is a simple truth few have the patience to accept in investing. Most of the time, you do nothing. You wait. Wait for opportunity. Wait for fair prices. Wait for the market to finish its frenzy and sober up. The hard part is waiting without going crazy, without doubting yourself, without wondering if you're wasting your life. The most essential quality of all, the one that truly defines the right stuff, is inner stillness. It is the ability to sit alone in silence, without the urge to act, without being pulled by emotion, without pressure from anyone else. If you can maintain that calm, you can invest and live with clarity. I once faced two choices. One was to chase a deal everyone swore was a sure thing, paper profits of 200% in 6 months. The other was to walk away because something felt off, a small detail in the audit report, an unusual change in management. I chose to stand aside. 6 months later the company was hit by a major financial scandal. The stock fell 90%. At that moment I didn't feel clever. I felt lucky. But that luck came from being awake enough not to get swept along. The right stuff is not the ability to always be right. It is the ability not to lose catastrophically when wrong, and to live long enough so that when you're right, you capture the full cycle. That's why I always build portfolios on the principle of don't die when wrong. Because I know I will be wrong. Everyone is. But those with strong defenses can survive mistakes. Those without, one big mistake is game over. You can call it the art of defense. I call it the instinct for survival. And in the investing world, survival is the foundation of everything that can be built afterward. Part of having the right stuff is saying no to seductive temptations. I've seen countless tempting deals, promises from friends, colleagues, even media, all creating pressure. If you don't get in, you're stupid. If you get in late, you'll regret it. If you stay out, you're out of touch. But I don't care. I don't live to be fashionable. I live to have no regrets. And the greatest regret in investing is not missing an opportunity, it is knowing you were wrong and still stubbornly following through. People with the right stuff know no opportunity is the last one. The market always opens new doors, but you only have one key, your own discipline. Lose it, and you have nothing left to protect yourself. I've met many brilliant people. They can read financial statements like short stories. They remember every line of data. But they cannot say no to a risky deal just because they fear being left behind. They don't lack information. They lack backbone. The right stuff is that backbone, the ability not to collapse when the market roars, the ability to hold principle even when it makes you temporarily look foolish, the ability to play the long game without sacrificing strategy for small short-term wins. I have been wrong many times, but I survived. After each mistake, I dissected the emotion, re-examined the decision process. I don't blame. I don't make excuses. I just learn, so next time I err less, and when I'm right, it's deeper. The right stuff is not something anyone can give you. No teacher can teach it. No book can show it. You only find it through financial storms, through sleepless nights after a bad trade, through watching your portfolio burn red while remaining calm inside. I cannot tell you how to always be right. But I can show you how not to die from being wrong. And in my view, that is the most important thing any investor can learn. Because in the end, it's not the smartest who win, it's the ones who don't quit, who have principles, who possess the right stuff. The quality that carries them through cycle after cycle while others disappear from the table. Chapter 6: The 7 Variables in Graham's Value Investing System. After many years in the profession, I realized one important thing: investing only requires a few simple formulas. Over time, I learned more about financial analysis, business valuation, portfolio management, all the things taught in books. But after even more years, I came full circle back to something very simple. Every correct investment decision revolves around just a few core variables, not too many, only 7. But you must understand them as deeply as you understand your own personality. Graham called them the 7 variables, the core variables of the value investing system. For me, they are not lifeless numbers in an equation. They are 7 heartbeats, 7 patterns of reaction, 7 protective layers before you put money into any business. First variable, current earnings. Simple, yet astonishingly undervalued. People get mesmerized by growth prospects, expansion visions, distant promises. I ask, how much money is this company making right now? Not next year, not 10 years from now, right now. Where does that cash flow come from? Is it sustainable? Is it real? I don't believe in fantasy models. I need to know a business can support itself, and me, in the present reality. I've seen companies living on expectations rather than profits. They evaporated as fast as smoke after a policy wind. And the investors who followed them usually never came back. Second variable, future growth prospects. This is where psychology starts creeping in, because humans are creatures obsessed with the future. We are easily seduced by stories. If everything goes right, profits will multiply 5 times. I don't deny the importance of growth, but I always ask, where does this growth come from? Is it repeatable? Is there a competitive advantage that can sustain the momentum? I divide growth into 2 types. Real growth, from product improvement, market expansion, process optimization. Phantom growth, inflated by marketing, asset revaluation, or leverage. Guess which type attracts investors more? Of course, the phantom kind, because it tells a prettier story. But you don't invest in stories. You invest in cash flows. Third variable, dividend yield. Young people often ignore dividends. They prefer capital gains. They think, why accept a few % a year when I could 10x my account? I understand that. I once thought the same way. Until I saw that the discipline of paying dividends is a sign of a business that truly cares about shareholders and has enough internal strength to keep doing it. Dividends show me the company has real profits and is willing to share them. It's also a cushion during market crashes. I don't need to sell shares to get cash flow. I just sit and receive it year after year. It's not romantic, but extremely durable. Fourth variable, price-to-earnings ratio, P/E. A small number, yet one of the most misunderstood. People think low P/E equals cheap stock. Not necessarily. A low P/E can be the market warning that something is wrong, the business is in trouble, the model is obsolete, management lacks transparency. I never buy something just because it's cheap. I buy when it's cheap relative to true value. Similarly, a high P/E isn't always bad. If the company has high growth, strong competitive advantage, superior profitability, a high P/E can be justified. But you must check whether it's high because of quality or because of inflated expectations. I've seen stocks with P/E of 80 turn into negative P/E after one bad quarter. The market doesn't forgive fragile dreams. Fifth variable, asset value, net asset value, liquidation value. This is one of Graham's and our favorite variables. It measures, if the company were liquidated today, assets sold, debts paid, how much would be left for shareholders? Sometimes the market prices a company below its book value. If the company isn't bleeding heavily, isn't disintegrating, you may be looking at a rare opportunity. I once bought a company whose market cap was lower than the cash it held in the bank. Yes, just the cash in their accounts was worth more than the entire stock price. The rest, factories, equipment, staff, brand, came almost for free. Of course the question isn't is it cheap, but why is it so cheap? Sometimes the market is right to punish a business. Sometimes it's just panicking. I don't buy because it's cheap. I buy because I understand what I'm buying clearly enough that if the market closed for 3 years, I wouldn't worry. Sixth variable, financial position and debt structure. This is the variable most often overlooked until everything collapses. I always check a company's debt level the way a doctor checks a patient's pulse before surgery. A company with growing revenue but heavy debt is like a young person who looks healthy on the outside but has clogged arteries inside. Just one adverse wind, rising interest rates, credit tightening, and the whole system can collapse. I've seen beautiful on-paper businesses with high profits suddenly sell assets, sell brands, sell themselves when they couldn't borrow new money. I never invest in a company whose ability to service debt depends on growth expectations. I want them to be able to survive even if profits go to zero for a few years. Only those who can make it through winter with enough food in storage are worth traveling with. Seventh variable, and the most subtle, quality of management. This has no number, no chart, no quantitative metric, yet it carries decisive weight. I've passed on dozens of attractive businesses because I didn't trust the leadership. I've stayed with mediocre companies because I trusted the people steering them. Quality of management isn't just ethics. It's competence, transparency, candor in reporting, willingness to take responsibility when wrong, consistency between words and actions. I read every shareholder letter. I observe how they react in crises. I research their track record from previous companies. I don't need them to be perfect. I just need them to be people I can entrust money to and still sleep well at night. I know what I share isn't exciting to a generation that loves AI valuation models, automated charts, robo-advisors. But those who have truly lived through a full financial cycle will understand. In the end, what keeps you alive and moving forward isn't technology, it's thinking. And these 7 seemingly simple variables are the skeleton of solid thinking. I don't use the 7 variables as a scorecard. I use them as a filter. I don't need every variable to be perfect. But if 3 or 4 are outstanding and none flash red, I start paying attention. Then I dig deeper, layer by layer, like an archaeologist, never rushing, never letting emotion lead. Sometimes I reject an opportunity over one small footnote in the financial report. Sometimes I hold longer just because I see the CEO still taking salary in stock instead of cash. Those small details are not trivial to me. They are signals, and signals are worth more than promises. Value investing isn't about creating a perfect valuation model. It's about understanding a business clearly enough to know what you're buying, why you're buying it, and what you'll do if things go wrong. Graham's 7 variables, properly understood, give you the framework to answer those 3 questions solidly. And if you know how to use them, without hurry, without needing to be a genius, you won't just get one chance to get rich. You'll get the chance to get rich without anxiety, without regret, and without betraying yourself. Chapter 7: The Right Elements in a Business. Throughout all these years in the profession, I realized one crucial thing. You don't invest in stocks. You invest in businesses. The ticker symbol flashing on the screen is just the shell. Inside are people, strategies, culture, complex systems that never fully appear in financial statements. If you don't understand the business, you're gambling, not investing. And understanding a business means recognizing what gives it the right stuff, the true inequality that makes it worth holding long term. Not every company deserves to be kept forever. Some look beautiful, trendy products, impressive growth, but inside they're empty, inflated balloons of expectation. So what makes a business truly have the right stuff? First, I look at the business model. It must be simple, easy to understand, easy to predict. If I need 3 hours and 4 slides to figure out how the company makes money, I stop. I don't need complexity to prove intelligence. I need clarity to see survivability. Remember this: the business can be complex in its operations, but the way it makes money must be so simple that even a child can understand it. Coca-Cola sells soft drinks. Costco sells goods at low margins to keep loyal customers. Apple creates a closed ecosystem to keep users longer. The simpler it is, the easier to control, the more trustworthy. Next, I look for a durable competitive advantage, what we call a moat. Not every profitable business has a moat. You must distinguish clearly. Profit can come from a season, a trend, a policy. A moat is the ability to sustain that profit over time, through competition, through crises. A moat can come from brand, like Apple, low costs, Walmart, network effects, Visa, user data, Google, distribution systems, Amazon, or exclusive resource control, some mining companies. You must identify what the moat is and ask. If another company wanted to compete, how long would it take? How much money? How many mistakes? The third factor, often the most underrated, is corporate culture. Culture isn't on meeting room walls. It lives in how employees respond to risk, how leaders handle failure, how the company treats customers when no one is watching. A company with strong culture will stand by you through crises. A company with only slogans will crack the moment cash flow falters. I once saw two companies in the same industry, same size, same market conditions. One survived the 2008 crisis and emerged stronger. The other went bankrupt in less than 6 months. The difference? The first had a team willing to share the burden, leadership took pay cuts first, no mass layoffs. The second fired people en masse to hide losses and lost customer trust. One recovered. The other vanished. I also look at the ability to generate free cash flow, not accounting profit, not revenue, not EPS, real cash left after operating expenses and maintenance capex. If a business consistently produces free cash flow, even in slow growth periods, that's the sign of a durable machine. But cash flow alone isn't enough. I need to know what they do with it. Do they pay dividends? Buy back shares? Reinvest in high-return projects? Or do they blindly expand, inflate numbers, chase vanity? How a business uses money reveals the true character of its leadership. I call this capital allocation intelligence. Only a small fraction of companies have it. Most, even good ones, treat capital as if it's infinite, acquiring unrelated businesses, overpaying for marketing to buy growth. Then when cash flow stalls, they panic, cut, sell off, and lose their original position. One of my favorite questions when studying a business. If the CEO disappeared tomorrow, would the company still run well? If the system depends too heavily on one individual, no matter how brilliant, it's not a sustainable model. The right business is one that keeps printing money without someone shouting orders every day. I don't look for superhero-led companies. I look for companies with self-operating, efficient systems. That doesn't just come from technology or processes, it comes from stable, transparent organizational culture where every level understands the mission, role, and core values. And I always check consistency between words and actions. If a company says it cares about long-term shareholders, I look to see if they're diluting shares. If they claim commitment to the environment, I check real ESG actions. If they promise investment in core technology, I look at R&D spending and new product returns. People can say anything in a meeting. But financial numbers and cash flows tell the real story. I once followed a highly hyped tech company. The CEO gave passionate speeches, the product looked appealing, the strategy sounded breakthrough. But I noticed one small thing: each quarter, outstanding shares quietly increased, silent dilution. Marketing expenses ballooned faster than revenue. R&D stayed flat. The board sold shares regularly every quarter. 3 years later, the company didn't go bankrupt, but shareholders lost over 70% of value. I wasn't surprised. Then there are the opposite companies, no one talks about them, no glamour, but they grow steadily, no debt, stable dividends, buy back shares when prices are low, and leadership only speaks when truly necessary. 5 years later they become industry pillars. Anyone who held them got rich quietly. The right business also knows how to say no to reckless growth. I respect companies that refuse expansion unless efficiency is assured. I admire companies that close underperforming branches rather than keep pouring capital just to save face. Because a business that knows how to cut dead parts understands the most important thing: long-term survival matters more than looking good in the short term. I once said, a good business is like a money printing machine with non-arrogant operators. But I'll add one more thing. An excellent business is a money printing machine where the operators always put the long-term shareholders' interests first. They don't manipulate the stock price for quarterly bonuses. They build to last lifetimes. That's why I like family-controlled businesses, where the founder still holds a large stake, still sits at the table with grandchildren, still sees the company's stability as legacy rather than numbers. They don't need to prove anything to Wall Street. They just need the company not to collapse. That motivation protects real value far better than any hired CEO. Finally, I ask myself one question. If the market closed for 10 years, would I still be happy owning this business? If the answer is yes, that's a business with the right stuff. If I need hourly price updates to feel safe, then I'm not investing. I'm speculating. The right stuff in a business isn't a score. It's character, philosophy, the choices the company makes when no one is watching. You won't see it at an IPO. You won't feel it through a few industry description lines. But if you listen carefully, dig deep into reports, ask the right questions, you will see it. And when you do, you should hold on tight. Because such businesses are rare, but once found, they become the most precious assets you'll ever own. Closing. Here we don't just close a book. We have walked through an entire system of thought, where investing is no longer dry calculations, but a way of seeing the world, a way of looking inward at ourselves when making life and death decisions about money. Charlie Munger didn't teach us how to get rich fast. He taught us how not to slowly die in ignorance gilded with growth buzzwords. He didn't give formulas. He pointed to essence. And that essence, whether we agree or haven't yet fully grasped it, forces us to rethink the financial lifestyle we're pursuing. If you feel challenged, forced to question old beliefs, or even a little uneasy after hearing this book, then perhaps you're on the right path. Because real knowledge doesn't lull the reader to sleep. It makes us uncomfortable. It shakes us. It rebuilds the foundation. I know you may have come to this book just wanting to understand value investing better. But if you leave with a deeper view of yourself, of how you make decisions, of the role of humility in a world full of delusions, then perhaps you've received far more than any P/E ratio or valuation model could offer. I sincerely thank you for taking the time to listen to this entire book. In an age where patience is becoming a scarce asset, the fact that you made it to the end is not something I take lightly. If you found this book useful, please leave a comment, even a short one. Not for my praise, but so others, those lost in the sea of noisy information, can find a real source of light. Your sharing could become someone else's anchor in a wave of thought. And if there's any book that once changed your perspective, kept you up at night with its ideas, or one you simply wish to hear told with depth, please let me know. Because there is no journey more worthwhile than walking together in pursuit of knowledge, with a clear mind and a spirit ready to be challenged. Thank you once again. And if possible, please live and invest the way Munger did, with humble intelligence, relentless clarity, and the belief that the best things usually don't come with noise.